There?
Hello. Yes, hello. Hi, Keith. And hello, Simon. And Muscle Riot, Zach,
Yeah,
Tipster,
Tipster.
and Venture. Hi, everyone who's come and joined us at the start. Great to see you all again. And just to quickly go through the general plan is we're going to have a quick chat about the general markets. Then I'm going to go into some different stock sectors. We really kind of are going for a bit of an open forum, really, where we can all just discuss whatever's of interest. And I'll try and take a bit of a back seat a bit, and people can, if you click on the Rogue Trader screen up there, you can see I'm sharing my screen. So then you can see the slides I'm putting up, but then also as other people, I think last time Keith was typing stuff into the chat, so people were bringing up ideas.
Good point. Very good point. Let me get the chat going. So how to?
So people were coming up with different ideas, and then various people were posting data in the chat. So that's you can then see that if you're on the on my screen, and then we'll see if we can get some interesting and unexpected twists and turns in the discussion.
Right.
And then finally, I'll do a stock analysis blitz on Persimmon, and we can talk a bit about house prices. And then we'll then leave it open again. So,
Fantastic.
So first of all, is there anybody new here who'd like to introduce themselves, or who we haven't heard from before?
Well, Ro, why don't you get going with your analysis? What you think about the all share and the direction of equity markets, and then I think we just have a free for all, and anyone who wants to come in, give their halfpenny worth, does so. Does that sound all right?
So, okay, so obviously on your, on your weekly update show, for years now, it seems, it's been a deluge of negative data. And the big question is, where is this big crash that we've been waiting for? Now, of course, as we discussed at the last call we did, and actually as Simon pointed out, this is the FTSE 100 I've got here, but actually we know that the FTSE 100 is a bit of a idiosyncratic index, because only the top 10 stocks are about half of the market cap, and it's large kind of monopolistic, often defensive stocks. So it doesn't really tell you anything about what's really going on. And actually, the same is for the S&P 500, which I've just put up. My computer's running slow, so it's taking ages for the everything to blink in there. But about 6 months ago, we had a chat on your Discord channel, and I drew this Goldilocks possibility, and I can remember consternation amongst some of the people. But can you believe we've actually had a Goldilocks little rally there? But again,
I mean, the thing is, Rogue, what I'd say is the S&P 500 has done amazingly well. But, when you look at the the causes for that rally, it really is 7 stocks. And if you look at, the revenues and the earnings of those stocks, the revenue growth has actually been negative for 5 of them. And it's just, there's just no way on earth anyone could have predicted that. So the entirety of the increase in the S&P 500 has been a very small number of stocks whose PE ratios have been going up. The fundamentals are against it. And, you can defy the fundamentals for a certain amount of time, but ultimately they tend to reassert themselves. And, last week I was talking about the build up to the 1929 crash, when the Federal Reserve was increasing interest rates and doing QT, and the Dow Jones rallied 85%. But then the next year it all came crashing down. And I just think you have to be very careful about buying stocks, when the fundamentals are against you. I mean, the bottom line is, when interest rates are rising, the discount rate you should be applying to future earnings is high. And so naturally equity markets should be coming down, and they're not. And that just doesn't, the fundamentals are against equities at this point.
Unless you think the interest rate discount rate is going to come down over a hump. It goes over a hump and comes down, and then people are foreseeing that, maybe mistakenly. But I think your point about PE expansion is very good, because that's what happened in the dot-com bubble. I mean, you just got enormous PEs, and you got PE expansion on a lot of the other parts of the market. And when that turns, it can be very sudden and a very quick reversion to the mean, if you like, and something to be very much aware of, I think.
No, I agree. But the other thing, Simon, is that we know that interest rates, they'll probably come down in a year or so's time. And the inflation numbers today were frankly terrific in the US. But the odds on the July rate hike didn't change. There's a 94% chance, according to the markets, the Fed will raise again in July. And you know that this huge stock of corporate debt, if it's refinanced at current rates, then the interest bill for US corporations is going to go up. And that means earnings have to come down. So I just think as soon as we get a turn in the earnings cycle, and so far earnings have held up very well, but you can't have companies hoarding labor and their interest bills going up and earnings continue to grow. At some stage, earnings start to decline. And when that happens, I just think the rug is pulled out from under this market. Now, I realize I've been wrong for much of this year, but actually, how wrong have I been? The FTSE's done nothing at all. The DAX is just astonishing, given the fact that Germany is actually in recession. And the S&P 500, well, the small caps and the 97% of the S&P 500 has done nothing. It's just the top 10 basically. So I would be very wary of buying in at these levels.
Yeah, I do agree with you. And here we look at the top 25 stocks, which is actually only 5% of the total, which is 46% of the entire market cap of the S&P 500. And we see that it's dominated with computer hardware, computer hybrid, and what I've called internet portal stocks. So there's obviously been a lot of hype around artificial intelligence, but it's certainly not, for me, it's not really of relevance to, well, I feel a bit like I've missed it if that was the thing. And anyway, I tend to just invest in the UK. And so it's not really relevant to my investments in the UK markets.
Yeah.
I do actually plan to do a analysis of the top 10 US stocks, but that's going to take me till the end of the year. So I've missed that boat, and I've certainly not. I wonder if it will be a bit like a .com crash, because there's all this hype, but what's the actual? I feel like though I need to do work and actually look into all these companies and look at read how they work before I can actually believe in this rally.
Well, I'm just going to share a screen myself briefly, Rogue. Now, can people click on that and see that?
So you can click on watch stream.
Yeah, you watch.
And now we've got your stream.
And this is from the upcoming weekly. And on my point about the Magnificent Seven, Alphabet, Meta, Apple, Microsoft, Amazon, Nvidia, and Tesla, then if you look at the year-to-date change in estimated earnings, Nvidia, it's shot up, but for 5 of the 7, it's actually down. And the reason that their share price has done so well is the change in the PE ratio. So it's just absurd. Tesla's up 123% year to date, and its earnings are down 35%. And the reason it's up is its PE ratio has gone up 240%. I mean, you just can't buy that. I mean, that's like. So I would be very wary of buying in at these levels, frankly. Right, how do I close that?
Yeah, the only how I can click onto grid at the top to then zoom out to everyone. Actually, there's only one stock I could find in the FTSE which I know of anyway, which is a kind of computer hybrid stock, and that's Softcat. And I'm just digging that up now, but I had a quick check at their value to their earnings, and that's what I just want to bring up now, and that kind of tells me all I want to know as to whether or not I want to invest in them. So I'm just loading that up now. Okay. So okay, so sorry, I'm just okay, so yeah, here's Softcat.
Okay. So can you just explain what it does, Rogue?
So Softcat, they do kind of this cloud computing thing.
Okay.
So they basically now they actually aim, so your IBMs and your Google, they target massive corporations and do all their back end computing in vast centralized data centers. And so your WhatsApps and your YouTube and your all this kind of stuff, but then also any company that has lots of data, they use these centralized cloud systems, but then there's also kind of functionality involved where so let's say you're setting up boilers, you're fixing people's boilers or something. They give all their employees these tablets where they can, where the man comes around your house, or it might be in a shop. You go in your shop, buy something, and they're updating it on a tablet, and it could be for kind of quite bespoke situations depending on the company. And all this, it involves some kind of quite complex sort of computer software and hardware interfacing, and so companies come to them to organize all that. But they have quite a focus on this hybrid computing, which is the same as where actually a lot of Google's money now is in this so-called hybrid computing. So Softcat are the nearest thing to a kind of FANG stock I could think of in the UK, and we see here that their market cap is 2.4 billion, but their net income is only 0.1 billion. And you see down here the tiny cyan line, that's their actual net income. And so if you think about when you look at their growth over the next 5, even if they achieve 10% growth, so here's their net income here, even if they achieve 10% growth every year for the next 5 years, it still looks a bit overvalued to me.
Well, the thing is, if you go back to that chart, Vogue, I mean, this illustrates exactly what I was saying. That you look at the market cap. The market cap shot up, but its revenues have actually gone down, and they've gone down quite substantially. What's that? An estimated drop of, that looks like the best part of 30% in 2023.
Yes.
So, if the revenues are going down, shouldn't the share price be going down? It's meant to be a growth stock, and that's, my point is the same about the, the Magnificent Seven in the US. I mean, the revenues are going down, the earnings are going down. Shouldn't the share price be going down? In fact, the share price has shot up. I mean, you just can't predict that. And it just seems totally illogical to me.
And I mean, what's the price to earnings ratio of Tesla?
Hang on. 79.
Wow.
According to estimated 2023 earnings. Alphabet's on 21, Meta's on 22. Actually, those aren't unreasonable. Apple's on 31, Microsoft 33, Amazon 50, Nvidia 60.
So, yeah. So I'm still don't trust that at all. I'm interested. I think it's interesting to learn about AI, how that's going to affect the world, and it's worth looking into those stocks. But that's a lot of work, so I've definitely missed that one. But
well, the thing is, one thing I'd say, Rogue, is that in any technology bubble, you want to be buying the picks and shovels rather than the actual miners. And I sadly have formed, as Nvidia provides basically the infrastructure for the AI revolution. So Nvidia, even though it's ridiculously valued, it could be a good speculation because I've consistently ignored all these bubbles to my own cost. And I remember, I'm old enough to remember the dot-com bubble, and I got out of equities in 1996 when they'd all gone up about 30 to 60%, and I thought the valuations were idiotic. Well, what a fool I was. They carried on going through the moon for another 4 years. And so, if the animal spirits are there, then these things can just keep on going. But I personally would just prefer not to get involved because, the vast majority of people who buy into a bubble will lose their money. You have to be willing to get out towards the top. And everyone says they will do that, but the vast majority of people, by definition, can't.
So I agree totally. And the main point is that the S&P 500, it doesn't really tell us about how the majority of the listed companies are doing. It just, all it tells us is how much money is being pushed into a small selection of about 20 stocks in the US. And so that's why now I really only use the FTSE 250 as like a benchmark. Let's just wait another 10 seconds for all my crayon drawings to emerge on there. But here, actually, when we look at the FTSE 250, and actually, I'll just quickly, for those who haven't seen it, we'll just have a quick recap on what's in the FTSE 250. So this is all the stocks from stock number 101 up to stock number 350 in the FTSE. And as you can see, there are much more mixed bag of all kinds of main street kind of companies. So this better represents how the kind of main street economy is doing. And another interesting thing, though, is that 30% of it is investment funds. So that's just where rich families and individuals have put money into these investment funds, who then just invest that money in other stocks and private equity, which gives it a bit of whiz one way or the other. It kind of acts like that 30% investment fund kind of perhaps adds to the volatility a bit.
No, I completely agree. Because if people lose confidence in the market, then those investment funds go to a discount, and that exacerbates the fall.
So anyway, however, if you look at the FTSE 250, we are actually now 2 years into a bear market. So, so anyone who's been watching your show every week for the last 2 years and just thinking, "Oh my God, there's so much doom and gloom, and there's all this really horrible data." Well, actually, if you take away the crank stocks, which are the FTSE 100 stocks and the S&P ones, actually we are 2 years into a bear market. So and that is reflected here. So for me, it's like a question of is this going to turn now, or is it going to be a 3-year or 4-year bear market?
Can I come in there, Rogue? Actually,
sure.
Because I have very strong views about the UK now, and I'd be interested in what other people think, because I think the data we had this week was that, sorry, it was last week, where the UK economy is definitely starting to slow. And what's happened in the last 2 months is we've had an enormous monetary tightening. So the Bank of England hasn't raised interest rates fast enough. So the markets have raised interest rates for it. And those interest rates will affect everything. They will affect mortgages, but also they'll affect all sorts of investments. And people are going to have to spend more on their mortgages, and investments going to be discouraged. And I just can't see any way the UK doesn't escape a recession. If you have to, when all the debts in the economy are refinanced at these higher rates, then the interest rate bill goes up, there's less money to spend. So I just think the UK, domestically orientated UK stocks, are in for a really tough time over the next 18 months.
Yes.
Simon W., what's your thoughts? Because I think you're more bullish than I am.
Yeah, not on the 250. I've just posted on the chat there that that technically looks poor to me, and I think it's at least got a mid bottom to go again, or test a low. I don't think there's a recovery given the fundamentals that you've just mentioned. That interest rates are going to bite hard on all these kind of mid-cap stocks, I think, for sure.
Yeah.
If not
Because the thing
consumption.
is, yeah, in the UK, interest rates have been rising really fast. And you know that interest rates act with a lag, a lag of up to 18 months. So all that tightening has yet to really start affecting the economy. And it will start to affect the economy over the coming months. And it's already slowing. Honestly, I think the UK is in for a tough time over the next year. And it will get inflation under control, but it'll get inflation under control at a cost. And that cost is a recession.
Yes.
Yeah, I can see exactly what you're saying. And you can see that the money they printed and they injected into the economy, this is what I think anyway, they injected a pile of money into the economy over to COVID, more than the entire QE before that they printed, 850 billion. And that is now working its way through services. So we can see service inflation taking off in the States and here. So you can see around wherever you look, airports are full, people are going on holiday, all restaurants are full, pubs are full, and things seem to be booming. But yeah, it's just gonna, as the money supply is tightened, and it has been tightened, and it's dropped, then in Q4 we're going to start getting real signs of recession. That's what I think.
Yeah, no, I completely agree with you, Muscle. I mean, I think the thing is that, back in the pandemic, we both cut interest rates to zero, did enormous amounts of QE, but also did loads of fiscal. And that combination of loads of fiscal and cutting interest rates, well, you certainly got inflation going. But if you now look at what's happening, well, Jeremy Hunt this week was talking about trying to find savings to fund the public sector pay rises, i.e., he doesn't want to borrow anymore. So he's trying to restrain fiscal, and the monetary tightening is really tight, not due to the Bank of England, but because the markets have lost confidence in the Bank of England. And I think the UK economy slows, and you can already see it in the form of the claimant count going up, unemployment rising. The UK economy is slowing.
Yeah, it's just that it's taken such a long time, and there's been no signs up till now. Really, as you see, as you go out and as you interact with people, full employment. House prices still pretty stable. So yeah, I think I know a buy-to-let landlord friend of mine, and he's trying to offload and sell everything he can because the interest rates he's having to pay are just so 7%. He's on an interest only, and he just cannot afford it, and his tenants couldn't possibly afford it, and he can't raise the rents, so he's sort of trapped. So you can start see it, you can see it as you go along, and it's just going to get worse.
Well, that's a really interesting point, because the point is he hasn't sold yet, and there were lags in the system. He will be financially stretched, but he'll hold on for as long as he can, and it's this. Everyone else in the economy is doing the same, but eventually things start to precipitate. People can't hold on any longer.
Yeah, there's definitely a delay to all this. We expect things to react instantaneously, but on the buy-to-let side, I'm on variable interest rates as well, and now I'm break even, and probably next month or next quarter, because it's a quarterly review, I'll be negative on a cash flow basis. So the only alternative, if you want to keep the property, is to pay down the debt. Paying down the debt then gives you a double whammy, because you get rid of the debt, which is a discipline in itself, and then you've got the income which continues to come in, certainly in the London southeast area. But yeah, people are not going to be making money on buy-to-lets. I'm 30% loan to value, so if I'm not making 30% loan to value. I mean, people with higher loan to values are definitely suffering.
Sorry, Simon, can you just explain what you meant by the quarterly review? How does that work?
Well, my interest rates are based on a base margin plus a variable, which the bank decides, and you can choose to set that every 6 months, every quarter, or every month. And
Right, okay.
I have one on a quarterly fix and one on a monthly fix. So one is more responsive than the other, but the quarterly fix obviously gives you a lag into higher interest rates, but then on the downhill side will give you a lag into lower interest rates. So
Yeah.
gives a bit of time comfort.
So are you on the standard variable rate then, which is now, I believe, something like 7%?
No, it's slightly less because the base margin I have is about 2%. So it's about 4, 5, 6 right now.
Okay.
So we had a good margin, a good margin deal, basically.
Right.
Yeah, the only thing I would add is to say that, you know, a lot of that debt has been devalued, hasn't it? You know, if you had a lot of property debt or whatever debt that you pay in interest only, it's been devalued by inflation at 10% during 2021, and then 2, and then 6% 2023. And what the government seems to be doing is raising because we've got full employment, nominal incomes are going up because they've got a whole economic philosophy where they keep the rate of nominal GDP growing and they keep the rate of interest below that. So, you know, what's to say that you just can't carry on, you know, getting more and more indebted? So that's another sort of aspect to this, that, you know, you would think there's a definite recession coming, but you never know what, you know, if this philosophy they've got, this economic sort of framework that they've got, and it's in the ECB and it's in the US, and they've all discussed it amongst themselves. It's called I minus G. I is less than G, so the interest rate is less than the rate of nominal GDP. Right. So if they can keep full employment, full wages going, then the debt will gradually be inflated away and the debt burden will be lowered.
Yes. No, absolutely. And historically, that has been the case. But in both the UK and the US, we have massively increased the fiscal deficit during the pandemic. And we're just not going to grow fast enough if we get inflation under control, because as you say, it's a question of nominal GDP growth. But the trouble is, we have an enormous stock of existing debt, and if that were refinanced at these higher interest rates, then a lot of borrowers go bankrupt. So we need to get interest rates down to make the debt sustainable.
Yeah. So we need the recession as a temporary measure. Yeah.
Because the thing is, on your point that you know, we have had nominal GDP growth, nominal earnings growth. If, for example, you have let's say you've got borrowings of 100% of your earnings, and your earnings go up by 10%, well, if interest rates double, then you know your interest bill goes up much more than your earnings do, and that's what's happened because you know interest rates were what 3% in the UK, and they're now what 6.5%. So yes, your earnings have gone up, but your interest bill's doubled. Yeah.
Yeah, I've just put.
See what you're saying. Yeah.
I've just put up a graph there of the GDP accounted for inflation versus inflation. So that explains how even in the US, even though GDP is seemingly rising, when you take account of the inflation outpacing that, we're still treading water, and the situation's a lot worse in the UK
Yes. In the UK, a lot of our debt is index linked. So not only about a third of the government fiscal debt, like the debt issued, are index linked. But if you think of the other liabilities such as pensions, those are all index linked as well. So actually, the UK is in a relatively poor position versus other countries in its ability to inflate away the debt, because a lot of the debt is index linked.
So I'll just my final.
Seem to have, sorry.
Sorry, Muscle Riot. Sorry, have
Yeah,
you
I was
any
just
further
saying.
to add?
Yeah, I was just saying they seem to be having a very good go at inflating away the debt. I mean, this sort of thing. You know, hear stories from the 80s where people had the debts basically, these massive mortgages, the interest rates are going up, but the debt inflated away at such a rate that going forward a few years, it wasn't a problem, you know, as their earnings went up and they could pay it off. And that's why I think bondholders are in for a shock, you know, because I still think that this is going to be the framework to erode away the debt, to inflate away the debt. So, yeah, sorry.
Well, so obviously, Muscle Riot, I have my portfolio is the antithesis of that. And the reason is that when we look back into the 70s, when you're absolutely right that lots of debts were inflated away by the inflation of the 1970s, well, debt burdens were much lower. And the reason that burdens were much lower was that interest rates, real interest rates, were much higher, because there was a lot of uncertainty about the future path of interest rates. So in order to lend to you, borrowers demanded a much bigger risk premium. And what happened after 1982 was central banks invented inflation targeting, and the volatility of interest rates came right down. And the flip side of that is there's been an enormous increase in private sector indebtedness. And so if you have a big rise in interest rates as you've got now, then that interest rate rise works on a much larger stock of debt. And I just think that kills the economy. And in the UK, you know, as I've said, I don't think we can inflate away the debt very effectively because so much of it's index linked. So the Bank of England and the government have been very clear that we need to get inflation down.
Yeah, well, you've already inflated away 17%, you know, at sort of 10% and 6% for this year. So,
Yeah.
And they've paid 5% back, sort of thing, to savers and holders of bonds. So that has already happened. So people I would have thought, would be saying, look, we need higher interest rates. We can't trust this government because they've already inflated us away. So I would have thought foreign investors are about a third of the debt, I think it is. They would start selling off the debt. Pension funds will start selling off bonds. And that's, you know, that's where I am on that. So,
well,
Yeah.
the thing is, the time to do that was before the surge in inflation. Because I think now, as interest rates peak, and frankly, I think they're peaking because I think that the UK economy is just about to roll over. And as the economy rolls over, then you create slack in the labour market, inflation comes down, and inflation can come down very quickly. And the thing is, in the US, we've seen that inflation this month, as of today, that was a 3% print year on year. And if you look back at what people were predicting in July last year, the Bloomberg economic model gave a 0% probability that US inflation would be less than 4% at the end of 2023. They thought it'd be much higher. And it's at 3% now. So, you know, if you create slack in the labour market, then, you know, inflation's very volatile. It could come down really quickly.
yeah, well, that's the rate of inflation, isn't it? So the actual cost of a loaf or you know, wherever. But that's still double what, you know, 50% up on where it was. So
Yeah,
30% up, you know, so that hasn't stopped. And if Labour, you know, doesn't come, if there is no slack created, I agree they're going to create the slack. We're going to get a recession. But, you know, if that carried on, then obviously it would be back to the 70s with unionisation and things, just to try and get back that standard of living that's been lost. So you can see that in National Express or the postal, all these strikes that are happening now, you know, so that's obviously what Bailey's concentrating on now to try and stop that.
Absolutely.
And I agree with Muscle Riot that I think that interest rates could stay high for quite a long time, more than you'd expect, but for me, I'm coming from a different angle of inflation. I think the inflation is so out of control. And actually today we had some US inflation data, which I'm just sharing on the screen now. And although US inflation is low, well, people are saying it's low at what works out at about 3% year on year, but it kind of works out, according to my calculations, to be about 5% for the year. So I think it's well above the 2% target, but everyone's saying, yay, inflation's going down. But if you look here, you see that in today's inflation report, the reason why inflation was only the reason why inflation was only plus 0.3% month on month or 3% year on year, which is actually quite high inflation. But the reason why it was only that level was because we had energy deflation. And that for me is quite a warning sign, because if that energy is kind of a bit of a kind of fickle sector, which take that away and you still got a problem. And in the UK we've got very high inflation in comparison, and in the rest of the world we've got breakneck inflation. So I think I've got a hunch that interest rates are going to stay high for quite some time because of the inflation problem.
Right. Can I just come in? I've shared my screen. I've got quite a lot coming up in the weekly about US inflation, and you're right on a year-on-year basis that the year-on-year figures are flattered by the fall in energy prices. But if you look at the let me see, can you see that? Right. Okay. If you look at the monthly breakdown, so this is the breakdown for June, and what you're looking at is the black small bars. What you can see is that there's hardly any inflation, actually. So yes, on a yearly basis, you've had these big negative components due to the fall in oil prices, but when you look at the black bars, which is month on month, there's not much. And in fact, you know that shelter is artificially high in the US because of the lags in owner equivalent rent. Everything. So I'm trying to navigate the right. If you look at the CPI using real-time shelter rather than the owner equivalent rents, it basically fallen to pretty much zero in June. So every way you measure it, and I've got quite a lot coming up in the weekly this week about the different ways you can look at inflation in the US. Every way you look at it, it's coming down.
Yeah,
Sticky,
that's a good shout.
etc.
That's a good shout because my data there that's year on year. So your data's better because it's month on month, and I agree. I agree that it's. Hang on, let me go into
But hang
matrix
on,
view.
can I just continue
I
though?
agree
Because
that month on
on
month.
your
Yeah.
point, why the US is different and why I think there's the way I'm thinking about inflation around the world is on Musselwhite's point. During the pandemic, we had massive fiscal and monetary stimulus, and crucially, we then had a lot of people leave the workforce everywhere. We had people either retire or go long-term sick, and that left labour markets very tight. Now, the reason that I think the US is having a good outcome is they've opened the immigration floodgates again. And so they've solved their labour problems by adding a load of labour supply. In Europe, unemployment, particularly youth unemployment, is much higher than it is in the UK. And so labour markets, although they're tight by historic standards in Europe, they're nowhere near as tight as they are in the UK. In the UK, we've had Brexit and we haven't let enough new workers in. So we have structurally tight labour markets. And therefore, if we want to solve the inflation problem, we have to cause a recession to get to reduce demand because we haven't increased supply. And therefore, I think you're right that interest rates will stay high, whether the Bank of England likes it or not, until inflation starts to come down. But inflation could start to come down very quickly if we get some slack in the labour market, because we know that food inflation is now starting to fade and there are lots of transitory effects which are coming out. We're now having deflation in food on a month-on-month basis.
Yeah. So although things are kind of looking kind of relatively rosy in the US, in the UK, we aren't a net oil and gas exporter, and we don't have a world reserve currency like the US does, and so I think we are in a lot worse situation than they are, and the rest of the world is, and it will just be interesting to see if the rest of the world brings down the US or not, or if the US is basically walking on the sunny side of the street, whilst Europe and the rest of the world sort of struggles for the next 5 years or something.
Well, the other thing I'm talking about this week and the weekly is the relative performance of the UK. And, since 2010, we haven't done that badly versus the other G7 on a GDP basis. And France, I think, could be in quite a lot of trouble. Actually, let me share with you some, if I can find it, some charts on France. In that, we've forgotten that the Eurozone is such a diverse range of countries, and France has got absolutely enormous debts compared to Germany, and they will be suffering as interest rates rise in a way that the other European countries won't. So the Eurozone crisis in my books hasn't really gone away, and you tend to get crises. Let me share this with you now. You tend to get crises during a recession. Can you see that?
So that's up.
Yeah. Can you see private sector debt to GDP ratios?
Yes.
And
with France at 230%.
yeah. So, I've seen this data actually from lots of different sources. France has a big debt problem, and the ECB sets one interest rate for the whole of the Eurozone. And last week we showed you that chart of French food consumption, which was really frightening. So, French people are eating 10% less than they were. And I just wonder, the ECB is continuing tightening. And I think the Eurozone, the contradictions in the Eurozone could come back to bite it. We know the Eurozone economy is slowing, and there's a huge divergence in inflation outcomes in Europe. And the ECB has set one interest rate. And the trouble is, that one interest rate could be way too tight for some of the economies in Europe, such as France. So just putting that out there.
Yeah, I mean, that's why I've always thought that the EU project is, that's certainly the Achilles heel in the EU project, that it's ridiculous to try and manage such a diverse set of economies with one currency.
Yeah.
But it kind of, in a way, though, it's kind of a bribery. So obviously, all the different countries pay different amounts to then get shared out. So it's kind of a bit like, Germany, the poorer countries go along with having a artificially strong currency. So Greece and Portugal, etc. And the Eastern Europe, they go along with having a artificially strong currency, because in return for that, Germany and France kind of gives them loads of handout money. Is kind of how it works, but I'm not a great fan of that myself. But I think that's definitely a long-term kind of threat to have on one's radar. Is a euro crisis, and it's interesting if that was to spring out of France. That would be, because if France has a crisis, France is supposed to be number 2 in that setup. So if France has a crisis, then the Eurozone really is in trouble.
Yeah. Well, actually, when we talk about France, Italy and Greece, I've just shared my screen again. Italy and Greece are doing quite well at the moment, and everyone's talking about, how Greece is, resurgent. But if you look at Italian and Greek GDP, they have really suffered over the last 10 years. So this is Italian GDP, and it is down from the great financial crisis. So they've really lost 15 years. GDP has fallen over the last 15 years in Italy. If we look at Greece is absolutely shocking. Greece has suffered what can only be described as a terrible depression over the last 15 years. So its GDP has fallen, what's that? By 2/7, what's that? 30%? It's 30% lower than it was 15 years ago. So, I think the Eurozone has actually been a bit of a disaster for those two countries. I mean, the thing is about gold is, in the long term, you'll be absolutely fine. It's just, in the short term, it can do anything.
Yeah. Well, it in the 80s, when they did have VOCA with real interest rates, it just absolutely crashed, didn't it?
It did.
To a fifth of the value of where it was. So, if that could happen again, it could halve the value. If they got aggressive enough with interest rate rises, it could come down, because I believe you can model it quite easily. You can build a gold model of what gold should be, such and such a real interest rate or negative interest rate. So,
but
I would have thought, if we ever do get positive interest rates, which we still don't have, then gold would start coming down. And it's not. I mean, I think you've got the credit risk, haven't you, with gold? So you've got that risk that the banking system will blow up through the huge debts and the private sector debts that you've said, and that's really, why I'm holding it. I think that's a real possibility.
Well, the other thing is when you look at the debt burdens in the UK and the US, gold is a claim on nobody. It's not. Whereas the US fiscal deficit, when you look at its trajectory, you think that just doesn't work. At some stage, you just can't repay that debt. You can't even service the interest rate on it. Whereas if you've got some gold, it's yours. Nobody can default on your gold, I say. But on your point about negative interest rates, I think we have to go back to negative real interest rates probably quite quickly. Because if you look at the Fed's estimates of what R star is, then R star is really quite low. The reality is that nothing really has changed. We've had this huge fiscal and monetary stimulus and the war in Ukraine. Once those shocks go out of the system, then we still have an aging population. We still have, importantly, just falling productivity. And real interest rates are highly linked to productivity. If productivity is high, then you can fund highly productive projects using expensive debt. If productivity is low, that doesn't work. The interest rate has to be low enough to encourage low productivity projects. And if you look at certainly UK productivity, it's absolutely terrible. So, I firmly believe that interest rates medium term fall right back again.
Yeah, and the other thing to add to that would be that they've constrained the banks so they cannot lend very effective by making them sort of lend in the most riskless manner. That come a recession, they're not going to be able to lend into any other area of the economy. So that again suggests that we get ZIRP again. So we get that QE to stimulate the economy and get the nominal rate back up. So I think you're right there.
Well, actually, you raise a really good point about the way credit has been has changed in the British economy. In fact, the US economy over the last 20 years is that banks no longer really lend to businesses. They do mortgages, but if you want, businesses now have to look for venture capital or something, or a friend of mine does mezzanine financing, and it is very difficult to get funding for new businesses.
So you have to get that from outside the system or issue bonds or something like that and be creative, because you won't get it from commercial bank yet.
Yeah.
And that's because the capital buffers that they've put in place after the great financial crash. So they've deliberately constrained the banks. So the banks are the most. So the problem, I would have thought previously, wouldn't have been in the banking system, but obviously they didn't actually account for the fact that they felt the mistake of buying bonds, and the bonds went down in value, and that's created all the bank problems in the US now. So,
the other thing I would say is when you look at UK GDP, there is an enormous break post GFC. And when we cracked down on our financial centre and made it take much less risk, we also hobbled the UK economy. And is it any coincidence that at that point, our banking system basically stopped lending to business, and so business has now had to find much more expensive forms of financing, and unsurprisingly, business in the UK startups are finding it much more difficult.
Well, it's been from one extreme to another extreme. That's what seems to be. So we've had totally crazy levels of unregulated bank lending in the. I mean, I believe the Royal Bank of Scotland lent 10 times the size of the economy on its books in debt, and then obviously they came in like after the horses bolted, after the everything's collapsed. They come in with all the right regulation, and then they overdo it. So, you know,
Yeah.
that's the way of things, isn't it? We can't
I completely agree.
anticipate anything.
Okay, so I'm back, I believe.
Right?
Can you hear me? Sorry about that. I'll remember not to press that button again. So, yeah. So before I move on to sectors, then perhaps you've given me lots to think about there, Keith, particularly with your monthly data on US inflation. So that although I'm a little obsessed with inflation and a stagflationary situation, looking at that US data, eventually all the misery should actually lead to a real reduction in inflation, and maybe we could start seeing that in the UK data, as you showed with the US most recent US monthly data. So
Yeah, no, but as I sorry, but Rhodes, come in. But as I said, I think the fundamental advantage the US has got is that it has less of a long-term sickness problem, and they've opened the immigration floodgates. So that's meant that they've got a lot more supply for labour. We have a much tighter labour market.
plus they've
But
got
the
lots
bottom
of
line
oil.
is,
Plus they're like a world
yes, yeah,
number one or number two exporter of oil.
yeah,
Whereas the whole of Europe and the UK are, unfortunately, we're gone back in time in terms of our energy infrastructure. So until we start getting the nuclear power plants going, which will take about 10 years.
And
Yeah.
cheap gas in the States as well. You know, a lot of cheap gas. Gas is a glut in the States. So anyone thinking of manufacturing should be heading off to the States for the next 20 years.
yes,
Exactly.
It's almost as if it's perfectly controlled, because it's almost too convenient that the US has affected this glut of gas perfectly in time for the reshoring of its manufacturing industry from China.
Well, it made the decision quite early that its strategy for renewables was not renewables, but was to transition to gas. So it structurally moved, I think, a lot earlier to gas than a lot of other countries. And so that induced people to go and drill up the shale gas rather than the shale oil. And the result here is pretty evident that you've got cheap gas for the next 20 or 30 years.
yeah. But also, a lot of that gas was as a byproduct of oil drilling. They weren't actually, aiming for gas, particularly in the Permian. And so, that gas essentially comes as a byproduct and free. So as gas prices in the US collapsed, they kept on producing it because they were after the oil.
Sure.
So, I mean, that's a whole lot to think about there. There is actually quite a big bull case for the US, isn't there? Relative to
Medium
everyone
term,
else, anyway.
Yeah.
So, okay, so I'm going to swiftly move on to the sectors then. So, oops, let me just rearrange my screens here a bit. I just need to pop out. So, okay, so I'm just having to fiddle around here with all the settings and stuff. Sorry about that. So, okay, so now I'm going to just quickly go through sectors. And let's have a look. Let's get that on there, the screen, so everyone can see it. So yeah, so I've got here, what I'm trying to do is, currently I'm actually very conservatively, very defensively poised at the moment. I'm only 30% in risky stuff. And the only thing that I've got significant investment in at the moment is uranium and oil. But these are kind of at their end game now. I'm kind of looking to sell because both those things, the uranium commodity, not uranium stocks. The oil there is oil stocks, but both of them are really, as far as I'm concerned, at the end game. I'm looking to sell them. So the problem is I've got nothing in my portfolio apart from the cash and other non-risky stuff. And so I'm looking for new sectors to invest in, and I want them to be stuff that's either completely nuked or it's kind of a fledgling thing just starting. So I want to get in there nice and early and sit back for a growth phase. So that's where now I'm looking at particular sectors. So I've got like a short list of sectors up here. So what I'm going to do is I'm just going to run through 5 of them or 4 of them, depending on how long it takes, and just see what your thoughts are. I thought it'd be a fun thing to discuss. So the first one is banking. So obviously I was interested in this because it's totally nuked. You can see how high here back in the year 2000, how high banking sector was, and then when there was the credit crisis, obviously they dropped to by 80% really, from 10,000 to 2,000, and they've still suffered ever since. And what you see is, if you see the lines there, so anyone who's watching who can't see what I'm talking about, click on the Rogue Trader screen and it should pop up so you'll be able to see. But you can see before the credit crisis we used to have high interest rates, and then ever since the credit crisis we had 0 interest rates, and then now we're up to 4% interest rates already, but actually we're still quite a long way down below. So in the most kind of basic, perhaps obvious or just the most basic level, I'm just sort of wondering, well, now that we're back to high interest rates again, will the banks make money? And I've noticed that if we go into the last 5 years, there does seem to be a channel there, like a technical channel. But other than that, that's the first stage. I've just identified the chart. The next steps is going to be to look at some banking stocks and try and decide what's going on here, what are the reasons why actually banks will stay trodden down, or could it be an interesting sector to invest in? So what do you think?
I mean, the thing is, Rogue, I think your instincts are quite right. And I think medium term, banks could be quite interesting because I think interest rates are going to be structurally higher than they have been pre-pandemic. But banks are very highly geared to the economic cycle. And in the UK, as we were discussing it earlier, we've got higher interest rates. We're going to have lots of corporate defaults because lots of companies were kept alive by, pandemic fiscal stimulus, etc. And now that their debts are coming up for refinancing, they go bust. And, as Simon was talking earlier about, buy to let, everyone who's got debt is potentially in trouble when they have to refinance. And I fully expect to see UK banks have lots of loan loss revisions as the economy slows. In the US, we have a couple of sections coming up in the weekly. Commercial real estate in the US looks really bad. Now, the big banks are not that exposed to real estate, but the small banks are. And when you look at the office revenues, they look awful. Essentially, there are lots of vacant buildings, which mean the remaining offices are competing for the fewer tenants. Rents have collapsed, and as those office buildings come up for refinancing, the mortgages come up for refinancing, then a lot of them are basically going to be handed back to the banks. And the prices have fallen about 50% over the last 3 years. So we're going to have a banking crisis in the US amongst the small banks. And the trouble is, once that gets going, you just don't know where contagion is going to lead. So I would be very wary about buying the banks now. I think your instincts are good, but I'd sit on your hands for a bit and, buy when the blood's on the streets.
Okay, has anyone else anything to say about the banks?
I would just echo exactly what Keith had said. I mean, you could see that the net interest margin that the bank makes its money off is going up, but they're set with all these other problems when we do head into this recession. So they've still got all the credit problems to worry about, and also people are moving money to money market funds, just as in the States. At least that's what I'm doing. The rates that they're paying on bank accounts are so ridiculously low still that they're coming up now, but they're still pretty low. So yeah, they face an exit of deposits and things like that. So
yeah, okay, so it's probably a dangerous one, a risky one.
Well, it's just not yet, frankly.
Yeah.
I mean, I think, I'm the last person who should be saying this, but it's, you should be patient and sit on your hands for a bit.
What I'll do, I'll just mention. So I've not really spent much time on banks, but what I did pick up, just a couple of interesting things I picked up, was when you look at their balance sheets 2005 and compare it to now, we see that actually they're making more money now than they were then when their share the share prices were much higher. In some cases, you might have to be careful about stock splits and stuff, but what I noticed as well is that's interesting is on the amount of cash on their balance sheets is now horrendously more than it used to be back in those days. So if you can see back in those days, now this could be like an accounting thing. I've not picked up, how different assets were reported on their balance sheets before and after the crisis. But this is Barclays here. But when I looked into it a bit, essentially their cash position is basically money quantitative easing. Basically, I think now this is kind of a bit of guesswork here for me, but it does appear that all of this money printed by the government you actually see appearing on the bank's balance sheets when you look at them, because you've got here cash and central bank balances as a accounting item on the Barclays balance sheet, and back in 2005 it used to be 4 million. Now it's 2.5 billion. No, so it used to be 4 billion. Million. So it used to be 4 billion. Now it's 256 billion. Wow. And that explains. So when you look at their, so when you look at this, all that cash that you see there, that's central bank. That's money that they've borrowed from the government during all these quantitative easing programs. So that tells you, when I look at, that's something I noticed that I thought I'd highlight, because I've only really just touched the surface, but there's some freaky stuff going on.
Sorry, Rogue. I think that's their cash they've deposited with the Bank of England, as opposed to money they've borrowed from the Bank of England.
So yes, so it says it's down as central bank balances. So it's money they've deposited at the
Bank of England.
So it's not money they've borrowed from the Bank of England. It's money they've deposited.
Yeah. But actually, when you're talking about the banks, I think it's a really interesting idea, because the other thing that's happened over the last decade is they've really cut costs, in that they've closed, the vast majority of their branches. And so when the economy turns round, they could be in a really sweet spot. Their net interest margin, as Musselwhite points out, will have increased, and they've massively cut their costs. So I think there is a time when the banks look really interesting. I just don't think it's yet.
Yeah, okay. So, but there's certainly, when you look at these certain line items, which I like I say, I've only touched the surface, but there's obviously very big differences to what a bank is now to what it was in 2005. So that's something to be wary of.
Yeah.
That kind of is something I noticed. So I'll heed your warnings. But so, okay, another one is telecoms. So telecoms I'm looking at mainly because, again, it's a totally nuked sector. And I need to do some work to understand them, understand what, I've got. This is obviously I'm just going from the charts at the moment and just finding some good ones before I start investigating. But obviously, telecoms make money from people surfing the internet, and the whole world is completely obsessed, addicted to, dependent on the internet. So surely it's got to be a good place to invest in. But you can see here they're at a low over, if you go back through the decades. So they're an interesting one. I don't know if anyone's got any thoughts on telecoms.
Well, I would just say that they've got no moat, really. They've got a lot of competition. So that's why they've got thin profit margins. And I have looked at a few of them, like Vodafone, and you see an incredible amount of debt. The debt is eye-watering. So, in fact, just Vodafone alone, how is it going to pay off that debt? And then also give 11% dividend, or whatever it is valued at now. And I can't see that happening, for long. So, yeah, but I wouldn't say that the particularly amazing sort of investment, unless there's another telecom company that I haven't looked at, that anyone can suggest. But it's not a great sector.
Yeah, I'm completely with Musselwhite, actually. I think essentially it's turning into a commodity. Every time you negotiate a new contract, you get more data for the same price. And voices, calls are essentially free now. So you have no moat. It's turning into a commodity. And the other thing I'd say is that governments have found a way of taking all the money from telecoms companies through these spectrum auctions. So they've got lots of debt. The fact that Vodafone has 11% dividend tells you all you need to know, really. The market is very concerned about the sustainability of the dividend. I would be wary.
Okay,
I would also, So, and I'd also say that Vodafone is like a legacy telecoms company, and I'm on Vodafone. They've upped my bill, and the rest of my family have literally a quarter of my bill because they use the Vodafone network via giffgaff. And the moment my contract ends, I'm going to go on to giffgaff with the rest of the family. I just don't think, Vodafone don't have a moat, and they're kind of, their profitability relies on keeping their legacy customers on very expensive bills, and I just don't think they can do it.
Yes, I mean, I'm just looking at their chart there. I hadn't actually looked at Vodafone yet. Thanks, Muscle Riot. They're, very low price at the moment, like you said. Isn't it fascinating how something where the entire country is just completely addicted to the internet, isn't it amazing how these companies are doing so badly? It almost makes me wonder if it's a bit like a utilities company, like water utilities, where if something's great of great necessity to society, the government kind of takes it over or controls it, corrals it. And so is that why it's impossible to make money in these things that people actually really need in their everyday lives?
Well, the thing is, I think there's quite a big difference between the utilities, which are actually state-regulated monopolies. I mean, Thames Water, who supply me, I can't get my water from everywhere else. But as Musselwhite says, Vodafone doesn't have a moat. It doesn't matter where I get my internet data from. I could get it from O2, from giffgaff, or whatever. There are loads of companies offering the same service that Vodafone does for actually a third of the price. So Vodafone's got loads of debt. I would worry about Vodafone, frankly.
And it's almost another perhaps worry about then this sector is you've basically got to, before you invest in it, you've got to be a tech expert. It's like you'd have to understand all the technical aspects of how the internet is set up and everything. So that, and it's never good to invest in something you don't understand. So, wow. So that's my first two ideas blown out of the water. And so that's why it's great to get other people's opinions. And that's why it's great to discuss different ideas in a forum like this. So now pharma and biotech. The bull case for pharma is we've got the world demographics are that we've got ever more older people. The developing countries are getting more wealthier, particularly places like China or etc. But there's generally a much larger older population in the world, and so also with modern medicine, people are just taking longer and longer to die. And so that's why I'm kind of bullish on the pharmaceutical company in the long run. Plus the government, they can't, I think one day one day when the younger people who are basically supporting older people will say enough's enough, and there'll be political change. But really, for a long time, governments are going to be subsidising healthcare, and so I'm fairly bullish on pharmaceuticals. But the thing is, they've kind of, in the long run, I noticed this real long-term trend. But unfortunately, we kind of ran away a bit recently. So I was thinking of maybe, because I am fairly bullish on pharmaceutical stocks, waiting for it to revert down to this kind of trend line before maybe going in at some time in the future.
Well, I think that's a great idea. My problem with pharmaceuticals is that in order to make good money, you really need to understand the pipeline. And I'm sure there are people on the Discord who have done the work, but I haven't done the work, and I just don't know which pharmaceutical companies have potentially interesting drugs in the pipeline. I completely agree with your thesis, though. What do other people think?
I think Richard Wilk has. We had a bit of a discussion on the general channel. Has some ideas of different drugs and the pipelines. But the only one I chanced on, because I don't usually look at pharmaceuticals for the very reason that Keith says you need to be a bit of an expert in these, but the only big trend I see is in diabetes and obesity. So I locked on to the providers of these potential drugs in the future. And I think based on long-term trends that Rogue Trader has identified, that pharma probably goes on for decades, if you like.
Yeah.
It may be a bit high now, but I thought buying at the top for Eli Lilly was high, but turned out not to be the case. So, yeah, identify maybe future diseases that are going to be costly for state-subsidized healthcare to provide, and they'll probably be winners, I think.
So Simon, which company did you look at for diabetes and drugs?
I looked at three: Eli Lilly, Novo Nordisk, and one other. I forget. I think it was a Danish company.
Okay. And which ones did you bought all three? Did you?
No,
Which ones did you like?
I went for Eli Lilly.
Right. Okay. Interesting. Thanks.
Yeah, I've actually had a very close look at GlaxoSmithKline, and there's so many random factors that can crash or boost any one individual stock. It's virtually impossible to stock pick of pharma stocks because there's chance events going on. And if I was to invest in the pharma sector, I would definitely do it via an ETF rather than doing individual stock picking. That I'm sure about.
Yes. I think that's a sound strategy. Yeah.
And actually, Charlie Munger said that as well. I saw one of his interviews.
Yeah, I was going to say Warren Buffett said something similar. He said they missed out on pharma. It's just because of this randomness to the pipeline, so many factors that you can't compute. That if you just buy an ETF, you're probably way better off.
Yeah.
So, okay, maybe we've got time for one more, and that's, in fact, oh no, go on, we've got to do two. Okay, as the last one's oil, we'll do two more. So, industrial metals and mining. Now, here, frankly, I'm thinking I want to wait for this recession to happen before going in, but I do think it would be great to invest in industrial metals when you think you can pick the bottom.
Yeah, I completely agree. However, you're assuming that industrial metals will recover to the levels they have done, and they bear in mind that the vast majority of metals demand comes from China. And I was listening to a podcast today making the case that China is falling into a balance sheet recession in the same way Japan was in the 1990s, and that it will undergo a decade of structurally low growth. And therefore that, China has had very extraordinarily high metals demand for the last 15 years as it's invested in, huge amounts of apartment blocks that need lots of steel and copper. Now, if it stops building those, then perhaps metals demand doesn't go back to the levels we've been used to the last few years. I mean, I think copper has a structural demand story, but I would be waiting for the bottom of the coming recession and then trying to pick things up on the cheap, particularly copper.
Yeah, when I've looked into raw material stocks, I've definitely found that the majority of demand is China. And when you look at the inventory levels in China, they've practically got mountains. In Europe, we've got the European Butter Mountain. Well, in China, they've got these vast mountains of copper and iron ore. So that's a very good point. Yeah.
Isn't the narrative for industrial metals basically electrification? And that's the trend to follow. I mean, it took off a bit about a couple of years ago, but then it's died down because I think everything got too expensive. That was my view. The costs of the industrial metals got too expensive, and people then couldn't afford the new technology, if you like. But as soon as infrastructure gets going, i.e., building hydrogen pipelines and changing the grid system and building new grids, then copper certainly could take off. But is anyone going to do that in the foreseeable future? That's the question. But as soon as they do it, I think there won't be enough, and that could give a highly leveraged play into industrial metals or electrification metals.
Actually, on that point, I've just shared my screen. Can everyone see that? So I keep a file of useful charts from the weekly, and we featured this chart last year. And then Woodmac were forecasting a copper surplus for the next 3 years. You can see here 23, 24, 25, and then we swing into deficit. And so I think that medium term, we know that copper is a big bull story. We don't have enough of it for the energy transition, as Simon was just saying. But the next few years is not quite so clear. And certainly the copper price has not been performing as well as the bull argument about the massive demand for copper from the energy transition would have us believe. So I'll stop sharing that now.
Yeah. So, but from that data you shared, 2024 would be the peak excess year, and so it's worth waiting. And should we see significant reductions, come 2024, it would be well worth spending some time looking at that, checking out a few stocks, working out how it ticks, and it could be one for the future.
No, absolutely. I completely agree with you on that, Rogue. And when we get to that point, I hope to do a few of these.
Yeah.
Where, we get a few people, each one of us, we kind of, 1 month we say, right, everyone go away and look at a copper stock. Let's meet next month and everyone do 5 minutes on what they've found. But I don't think we're there yet, because I completely agree with everyone that I think copper is a big bull story, and you have to look at companies with real copper production as opposed to speculative, projects. But let's cross that bridge when it comes to it. So SAC has just posted in the chat the chart of copper warehouse levels at the LME, and they've been falling a long way. So that would suggest the market's tight, but the copper price hasn't really been going anywhere. And what? Go on.
Yeah, with the London's now, I just heard people were bad talking the London Metals Exchange that it's been. I just heard on some commodities show something about people shying away from using the London Metals Exchange recently because there's been it's been disfavoured. They had a scandal the other year where they rolled back the trading. Someone had placed a massive bet on nickel or something, and then they actually rolled back the trading and then got sued for it. So I don't know. That could possibly be not because there's demand for copper in London. It might be because of a political thing where people are not using the London Metal Exchange.
Well, actually, I'd like to ask people on the Discord, because my thought about the level of stocks in the warehouses is that it's a function of what the warehouses are, the terms they're offering for stock. And historically, when levels have got low, they've been able to refill the warehouse levels while having no impact at all on the copper price. Does anyone know anything about the warehouse levels and their relationship to copper prices? I'll take that as a no, in which case, carry on, Rogue.
Okay, so last but certainly not the least, oil, gas and coal. And what's really interesting is obviously the whole world needs oil and gas because it's what powers our civilization, and you can't have a prosperous society without gas to turn into fertilizer and heat your homes and to run your factories, and oil to ship all the goods around the world. So it makes sense that long term there's a very volatile kind of gradual appreciation in the price of this sector. But what's interesting is we had an absolute triple whammy in 2020 because we had the OPEC shale war. Now, everyone's blaming it on the COVID crisis, but actually, I think the OPEC shale war had a big impact as well, where the basically the US had started developing shale oil, and the Saudis didn't like that, so they deliberately overproduced oil to force the price of oil down, to try and put all of the shale oil people out of business. So that was a very negative pressure on the price of oil in beginning of 2019. Then you had the COVID crisis, and then you also had, going along at the same time, the ESG war on oil, where there was governments and investor activists discrimination against oil companies, and all these factors, as you can see, we well on the chart on the left, we went well below the kind of lower line of this channel I drew, And I think that was because we had this extraordinary combination of those three events causing that. And I actually got into oil then, and then in 2021, and since then we've been in this rebound. But that's where now I'm kind of thinking we're in the end game, because we're kind of I've done okay from that, and now I've got to think about getting out basically. But I've only just started to get out. I've still got 75% of my oil positions I started with, but I'm on very aggressive stop losses, and I'm kind of thinking if we break this channel, then I'm going to start selling off. But it's kind of, at the moment, it's kind of hard to be honest. My gut feeling is I should be selling, and I'm probably attached to these stocks in a way I shouldn't be. But I've set some stop losses, so. But
Can I just come in, Ray? Because I mean, as you know, I play the oil cycle because I think it's really predictable. It's so oil has very high inelasticity of demand. So basically, you want to drive your car no matter what the oil price is. So small changes in supply and demand can send the oil price flying up or down. Now, as you also know, I sold all my oil companies last May, and the majors have actually done okay since then. They haven't flown, with the exception of BP, but the miners, the mid caps, have been absolutely decimated. And so I think that was a good decision, frankly. I mean, when I look at Jadestone Energy or Gulf Keystone, all of which I sold last May, they are, down 50 to 70%. Orcadian Energy, which we did a share talk on, is down something like 95% from where we sold it. So when we discussed it, these small oil companies have had a really terrible year. And I agree with you, medium term, oil just looks absolutely fantastic in that, nobody wants to invest in it. The ESG pressures are still there, although they seem to have ameliorated a bit. And the world economy is still growing. We still use vast amounts of oil. But the time to buy it is at the bottom of recession when nobody wants it. And I just think the world economy is slowing, China's slowing, Europe is slowing, the UK is slowing. I think that the US economy is going to have a difficult second half because you have the lagged effect of rising interest rates. You actually have fiscal tightening now in the form of the student loan repayments. You've possibly got a banking crisis. You've certainly got lots of commercial real estate which needs to be refinanced, which is going to stress the banking system. I certainly see the world economy slowing further in the second half. That's bad for oil. I think your instincts are right, but I would be waiting. Simon, what are your thoughts?
Yes, I mean, I think in general we tend to disagree on this oil and the cycle thesis, but I'm actually out of oil right now, but the trends of the stocks that I was in are still intact. And I think the medium to longer term we agree on is that oil is there for decades, and it's bullish on an increasing energy demand story from India and China. The issue, I think, as you say, is the short term. But I don't see the downside to the short term as being overly excessive, if you like, because OPEC have been pretty good, or OPEC Plus have been pretty good at taking supply off the market when they're kind of objective price, maybe between $75 and $85 a barrel, has been threatened. So I think to get out is probably not necessary. Of course, if you want to time the market, I'm not very good at timing the market. I'm more on the TA side for timing entries and exits, but I don't see short-term excessive downside, even if there's a recession towards the end of the year. If there is, it's going to be signaled, and I think OPEC will probably react pretty swiftly, as they've done in the last 18 months. So, I would be picking some stocks right now. They're at the bottom of the channel. Okay, if the channel breaks, that's a problem. But if the channel breaks, it's also an opportunity, because the medium to longer term is looking good, I think. I think too that they have to be US oil and gas companies. Not so much gas, more oil. Gas is in a bit of a glut, but US oil companies, because of the ESG love affair by Shell and BP, which they're backing off a bit, but in general, pick the super majors from the US, and you get paid a reasonable dividend to wait. And I don't think the downside correction, even if it occurs, will not be reacted to by OPEC.
Well, what I'd say is that when demand starts to fall in a recession, OPEC can cut, but they can't really support the oil price to the extent they would like to, because it ultimately all boils down to Saudi Arabia. Nobody else wants to cut. And if you look at the history of oil cycles, when we go into recession, OPEC can't stop the price falling. And on the risk reward payoff, I just see it skewed to the downside. And I would buy it when I think it's skewed to the upside, because what the last cycle taught me is that, in fact, what all the cycles tell me is you always underestimate the range. And last cycle, Shell peaked at £26. I started buying it at £13.50, thinking I was getting an absolute bargain. It went down to £9, at which point I was looking a bit of a fool. And I kept on buying it at that point. But, it's easy to underestimate how far things can fall. And the thing about oil companies is they are very volatile. So there is a time to buy them, but I'd be waiting that opportunity.
Yeah, I personally wouldn't be buying. Well, I'm obviously got the luxury of having bought them in 2021, so it's easy for me to say I wouldn't buy them now. But going back to the my slides, I'm trying to pick things. I want all my investments to be long term, and where I bought them when they were trashed, and then that's why I say oil is now something it's kind of, I'm in the end game, so I don't. I'm kind of, I'm ready to sell them if stop losses get hit, but those are kind of aggressive stop losses, and I'm kind of hopeful that there is some more upside, particularly if there's an inflation story playing out. But like, there's certainly positives to be said about the oil market at the moment, in terms of the lack of investment into new production in recent years.
Yeah.
If I was to do it all again, I think I would take Simon's advice, though, and I'd be signing the paperwork so that I can buy American shares and then investing in US oil stocks rather than UK oil stocks, because it's like a running comedy show. Shell, they're making big announcements about moving to renewable energy one year, then they're being taken to court the next year. The chief executive's been taken to court by Greenpeace the next year, and then they tend to do a full circle again, and then they're saying that they're focusing on oil again the year after. So it'd be much better. I wish I'd invested in US stocks rather than British stocks, I have to say.
Yeah. Well, were you going to talk about Persimmon?
Yeah, so I was just about to say. Okay, shall we? Do you want to go ahead with that? I was going to say, do you want to leave that for another time, or do you want me to do that now, and then we can move into general chat? I don't mind either.
Well, I'm quite interested, so I'd quite like to hear it, frankly.
Okay, so I'll go and do a stock analysis blitz for Persimmon. Now, normally, obviously, I prepare these stock blitzes I do in advance, and I edit out all of my little mistakes as I go. So this is the first time that I've done one live, so please go easy on me. But today we're taking a look at Persimmon, and they're a FTSE 100 listed home builder, currently with a 5.7% dividend yield. Now, the home builders, talking of sectors, home builders are a very interesting idea to invest in at different parts of the financial cycles when we used to have them, because you can try and go in when there's been like a recession and house price crash, and then you get, historically, when you look at their share prices, you get long runs of tasty dividends and nice share price growth, and it's a very simple business model, really. So it's a nice sector, I think, to be invested in if you're around at the right time. And obviously they just essentially buy land, build houses, sell the houses. They look for about a 30% markup on those houses. And if I just have a quick look here at their annual report, in fact, so here's their website, and obviously you have their glossy magazines, and obviously we're all I'm sure most of us here, even if you've not bought a new build, you've gone and taken a look. Keith's kind of screwing his, like he would never be seen at a wimpy home show. Well, show home.
I have had a look round them, and I've warned my children of ever buying one.
So now actually I do know some people who've bought high-end ones which were really nice, very expensive but very nice. I have to say there are some really good ones, but the mainstay, if you're like an average Joe, this is kind of what you get, what I've got here. And they're really, they look great in the brochure, and when they're first done they look great, but and you get the nice plan in the brochure of the new community, and you get the thing is, though, when you look at the actual floor plans, and bearing in mind this is a 330 grand house, they're actually a little bit cagey. And what I've noticed that they do when I went was they have lots of ensuite bathrooms, and they split it up into lots of bedrooms so that it kind of looks extravagant, when you're building the sales pitch. But in reality, when you actually look at them, they're kind of, the mid-range ones tend to be basically glorified ex-council houses, particularly 4 or 5 years in, they start to look a bit drab. But anyway, I think it's an amazing business model if the time's right. And what's good about Persimmon as well is they actually make their own bricks, make their own, foundations and timber frames, and they make their own roof tiles. So they actually manufacture all these parts of a house as well as building the house, which I thought was quite impressive, thus reducing their costs. And there's a really nice touch here, which is their FibreNest product, which is where they actually run their own internet company, so that when you're in the sales room and they're, in that high pressure situation when you're there with your loved one trying to decide if you're going to buy this house or not, they hit you with our FibreNest. You'll have the internet from day one when you move into the house. So that you don't even have to bother to go and find out your own internet, or heaven forbid, have to go for a couple of days without internet after moving in. So I thought that was a great thing they do. So look, we're all quite familiar with them. What they do, they have 3 different branches, which is Westbury Partnerships, which is their kind of social housing end. They have Charles Church, which is the posh houses, and then they have Persimmon Homes. But the thing is, Persimmon Homes, that's 80% of their revenue, and that's their mainstay. And actually, if you see the chart on the lower left, you see that the Persimmon Homes, there's no trend of any of the other ones becoming significant, really. Their business model revolves around the mainstay ones. So they do say there's a housing shortage. Apparently the government had a target of 500,000 homes a year, and there's only 250,000 a year off the top of my head being built. So there is like a long-term housing supply shortage, plus nobody's getting married and living in classical families anymore, so you get more single people, so then there's more demand on housing. So there is actually still a housing shortage argument. Of course, the elephant in the room at the moment is everyone thinks we're about to go into a house price crash. So perhaps should we? Do you think we should dwell on that now, or leave that till the end, Keith?
Well, why don't you just go through your analysis, and then we can have a general discussion.
Sure.
But actually, before you get going, last year immigration was 600,000 in this country. You're right about there being structurally short of houses.
Right. So so when we look at the long-term chart here, this is a 5-year chart. If you look at the many years chart, so they actually, if you'd invested these at the end of the last house price crash, you would be very happy about it. So that blue flag is the last house price crisis, which was in 2009, and it was, to be honest, it was only really a mini crisis anyway. Really, the house price didn't go down that much, but that share price then was £5.55. It then peaked at £32.48 in 2021. And however, since 2021, so in the last 2 years, it's gone down by about 66% in that time. So looking at the last 5 years, they've had a new CEO and a new CFO, and that's always a bad thing, really, normally a bad thing. We had obviously the COVID crisis, but in 2020 they did a trading update that everything was going great, and when I show you the data later, you'll see they've had really good data for 5 years in a row, right up to their last data. Now there's an interesting cladding issue, RNS, in 2021. So in this, they basically say, so you know the Glenfell fire tragedy, and then the government basically banned the dangerous cladding. So Persimmon, they weren't all that affected because most of their buildings are high rises, but quite a few of their houses did have cladding. But now, my interpretation of this is that they basically say, not our problem, we don't own them anymore because we've sold them. But we've put together 95 million in provision. That's my interpretation of that. Then they come up with a different RNS. So then they come up with a different RNS, this time only recently in, let's have a look, in 2023. So earlier this year they come up with another cladding update, and then here they basically say we're leading the industry, changing everyone's cladding for them. So what I think happened was, I actually saw in the news, actually, the government basically lent on the home builders and said, if you don't, even, despite what the contract said, if you don't go and sort these people out, we can cause some problems for you. So I think, but they did actually, I believe, try and get out of it initially, which they kind of legally could have done, because the contract said it was nothing to do with them once they'd sold the house. But anyway, so now that's led to a 350 million of provisions kicking in their 2022 annual report. So as you can see, that provisions aside, that provisions, by the way, is about 10% of their revenue. So in the long run, it's not that big a thing, but it's kind of a significant little headwind for now. But really, their share price, remember that from up to 2022, they've got amazing results. But you can see how their share price crashed from 30 quid to a tenner. And what we can see is during that time, we saw interest rates go up. So it's fascinating. It's almost like, they say that the stock market leads the economy. Well, it's fascinating that even though Persimmon were coming out with amazing results, even full year 2022, we see their share price go down by 2/3 as we see interest rates go up. And they're currently looking a bit unstable still, as we can see. It's hard to tell if that's the bottom now or what's to come. So one bit of data is completion. So they had their 2023 results just come out, and so it's interesting that actually the market kind of saw what was coming before it came, as I've just explained, because in this trading update that they released only last month, their Q1 trading update for 2023, all of a sudden we see completions down 40%, 30% drop in forward sales positions. There's been a trend of lower sales, more people cancelling the new homes they've already paid a deposit for. And they're building, so they're actually responding to this, and they're building 30% lower houses than they were a year ago. So it's just good, interesting to see the kind of market almost preempt that. So then to look at the numbers, and and ask the question, well, are they a bargain or what? So here we see their perfect data over the last 5 years, and their cost of sales has increased, and a lot of that is because of inflation. It costs more to build houses. We see here there's this other operating expenses creeping up, but not that significant. The only other thing is their provisions for their Glenfell style cladding they had to have provisions for, but that's only a one-off issue. So if you take into account that that's a one-off issue, they actually made 836 million in 2022, and so they've got a excellent net income profile. That dot there, which I've just clicked on, that's if you take out the cladding issues. This dot here is with the cladding issues. But, so they're looking good, really, apart from profitability narrowing a bit because it's costing more to get builders and fire up your brick ovens. But generally, are kind of looking good. But then their report comes out for Q3, their 2023, and then so obviously that we worry now about how it's going to look in 2023 if their sales are down 30%, etc. Then looking at their assets, and what's interesting is I'd expected long-term assets to be the mainstay of their books, but actually long-term assets barely get a mention. The majority of their assets are their short-term assets. So really most of their long-term assets are just their property, plant and equipment and intangibles. When you look at then what is the majority of their assets, the current assets, half of that roughly is the land they own. So they've obviously they constantly maintain a portfolio of land to build new houses on. Then there's houses they've built, they're ready to sell. That's 1 billion. And then cash. So really a very simple company in terms of the books composition. A few things to note is a build-up of inventories and a build-up of trade receivables, and their cash is falling as they've entered this difficult period. In terms of liabilities, they've got no long-term debt, and really most of their liabilities are their short-term again, which is mostly trade payables. And so actually fairly healthy books, but we're kind of a bit worried about how it's going to look. Are they going to be able to break even? Because if they were able to break even through a dip, maybe they're a good price now. Who knows? But who knows if they're going to be able to break even through the dip? So I've got here so here we see how actually now their market cap is actually lower than their assets. They've got a price to sales of 0.9, a price to book of 1, and they've got no debt. I built like a worst case and mid case of the next 5 years earning. This is, I mean, I didn't. This isn't a proper discount cash flow model. It's more my own bodge job. But I've just done some rough guesstimates where I've considered what if house prices went up or down, completions going up or down, and building materials costs, and from that, even with worst case, actually they're not a bad price. But the problem is though, what if there's a house price crash? Because then that would be serious write-offs, write-downs of their assets, plus also they could perhaps start losing money, in which case this becomes, rather than 5 months they're making in the next year, you could actually turn it red, and it's how much money they're losing in the next 5 years. So there's that to consider. There's a certain risk there that the market's obviously pricing in. So here you see the completions dropping compared with how it has been historically, and here we see that really all their sale is just for sale of new housing. They do make some money from part exchanges, where you can part exchange your house for a new build, and that's counted as a revenue. But so really, that's my stock analysis blitz really completed for Persimmon. And before I ask what you all think, I'm feeling that everyone's talking about a house price crash at the moment. And actually, no, I need to focus on this as part of my stock analysis blitz. So the my favourite source regarding house prices is, there's a really good website, housepricecrash.com, .co.uk, which has actually been around since 2009, and it actually, in nominal terms, house prices have remained steady. Even now, they're not actually really going down. If you look at it in against inflation, there is a crash started, but if that continued for a few years, we're deviating quite badly from the trend line. And one thing I can't help but think about housing is it is a inflation hedge. So currently I'm kind of myself, I've not got the stomach for it myself. This is only a blitz anyway, and I'd normally spend quite a few more hours before making an investment, but on this eyeball, they definitely go in my watch list, and they kind of entice me a bit about a cheeky, counterintuitive trade, because if house prices don't crash, and all over YouTube now, I've noticed a proliferation of YouTube channels dedicated to the house price crash, if you do a quick search on YouTube. So yeah, they look like an interesting cheeky bet, but that's as far as I'll say. They go on my watch list. I'll spend some more time on them in a few months when I've seen some more house price data as well. So that ends my stock analysis blitz for Persimmon.
Well, thanks, Rogue. That was really interesting. I mean, I really like the fact they've got no debt, but I would be really cautious at this point. I mean, I'd be interested in what other people think, but that's a falling knife. And, we've seen really big monetary tightening in the last 2 months that has yet to follow through. And actually, what I worry about Persimmon is that, so they've cut their production of new houses by 30%. So that's interesting. That is monetary policy in action. But you've got getting nominal falls in house prices, and they're suffering from input price inflation. So they're producing less houses, and their margin is going to get squeezed. Honestly, this sounds like a total disaster, and I would not be buying them until that equation changes, because you don't know how far house prices are going to fall. At the moment, nobody can afford new houses, and the people they're targeting, Persimmon are not selling high-end homes that cash-rich buyers are going to buy. The people buying Persimmon homes are going to need mortgages, and mortgage costs have just doubled over the last year, and their input costs have gone up through inflation, and the prices they're selling are going down. Honestly, this looks like a total, perfect storm, and it's gone down a long way. That makes it very interesting, but honestly, it could go down a lot further from here. I'll be interested in what other people think.
Well, if you look at the US house builders have been one of the best shares that could have bought, into a tightening cycle. They've been they're at very high valuations now. So I'm just wondering if, because of the demand in the UK and because rents are rising in the UK, if not, I'm not saying now, but at some point, just not too far away, that house prices do find a bottom just through supply and demand. And it is worth looking at these house builders.
Well, I think your instincts are right, Muscle, but just not yet. Because on the difference between the UK and the US, what the big difference between the UK and the US is the structure of the mortgage market. So in the US, people get 30-year fixed, and which they can't transfer. So if you have a house, you don't want to sell it because you've got a mortgage literally of 2%. And so nobody wants to move homes. Therefore, there are no existing homes on the market. If you want to buy a house, you have to buy a new house. That's why new homes are doing very well in the US. But also, the interest rates in the US are lower than they are here. The increase in interest rates in the UK has been really extraordinary. And I think that new home buyers are going to struggle to afford mortgages. I would be just cautious. I think you're right. At some stage, we get a new bull market in housing and you're off to the races. I just think you're too early.
If you look at
fair enough. And also there's the Labour government probably coming in, and I believe they've got some changes to how they treat the house building situation. So that'll be another thing to look at with the policies that they've got.
I mean, I see it is perhaps so house prices have held up over the last year, but everyone's talking about, now that interest rates are up, everyone's talking about the crash, but it hasn't happened yet. But maybe when you look at the Persimmon Q1 data for 2023, we see in real time maybe that crash starting, because the number of completions they've recorded is down 42%.
Wow.
And so, you know, these people who basically can't really afford a house anyway, who have been getting these new builds in a lot of cases, now they definitely can't get the mortgage with 5%. You know, people getting them with government schemes, banks basically lending money to anyone, and you know, like 90% mortgages, and you know, interest only mortgages. Well, maybe it just kind of makes sense that um, with the lending conditions now, the you know, the very customer that Persimmon relies on has evaporated. You could perhaps conjecture with this data, and then it makes you then worry about, well, is that then going to cause a house price crash?
Well, I mean, that 42% drop in completions, 45% in the non-association housing association ones, that is a huge fall. You know, and I really think their margins are going to be squeezed. So, you know, I think you need to wait until you see a turn in not only the interest rate cycle, but also, you know, turn in the economy, and then this looks like a really interesting share. But until then, I'd just be really wary of catching a falling knife.
Yeah.
But interesting, definitely one to put on the watch list, because, you know, if the bull market comes back, you could see it going back towards, you know, £30, was it? You know, 3 times what it is now.
Yeah.
And a real multi-bagger. But honestly, you know, I think it could go quite a lot lower yet.
Well,
if anything, this is a cyclical stock.
Yeah.
You know, housing is definitely something you follow the cycle on. Interest rates is pretty, it'll give you fair warning. Persimmon and Barclay Group used to be my core holdings. I used to hold them for income only when they were yielding around about 12%, and they were constantly yielding 12%. So I think this is definitely watch the cycle turn and then get back in. I exited Persimmon around about 1600, I think it was. I was a bit late, but still the dividends made all the difference, and I think they will do in the future. I think Persimmon is one of the best return on capital employed house builders, and they also have feed-in for pre-build. So they have, I think, a modular build which system which is quite efficient. So that ups their return on capital employed. That makes it an interesting stock, I think, from an efficiency point of view.
maybe what we'd like is for the Labour government to get in, and then they can build some 1950 styles prefab, giving the contract to Persimmon, and then solving the housing crisis all in one go.
Yeah.
Well,
I think
personally,
also, sorry, I think it also might be worth having a look at the shareholder register. I think I had a quick look. I think BlackRock have been dumping their shares over the last couple of months. Not sure if they're done, but yeah.
interesting. Yeah.
Well, I actually have. Okay, so if I know how to get that quite quick. So if I just write BlackRock, I thought it was one word. It's not. It's 2 words. So they,
Yeah.
as of so that as of, okay, maybe that was an RNS recently since this was published.
Yeah, I think on the 3rd of May they're holding 8.8%, just over 8.8.
So yeah, and that's a very good. Actually, that's a very good point, Zach, because so normally I do look at the shareholder composition when I do a main analysis, not just a blitz analysis. But that's a very good point, because what I've found in the past is the example being Hikma Pharmaceuticals. What I found in the past is once the big boys start selling, BlackRock starts selling, that can, that can send the stock way down, regardless of what happens. So that's a very good point. If and risk that if BlackRock and other major shareholders continue to sell, the share price is doomed, regardless of their results. And that's kind of what happens, isn't it? These fund managers, they all run like a herd of elephants from one side of the room to the other. And so a whole sector can kind of go in one direction like that when all the fund managers and pension fund, hedge funds are selling out of a particular sector. And like Simon said, this is a cyclical stock, and maybe the BlackRocks of this world have decided that it's reached the end of the cycle for home builders.
Well, I think it's a highly cyclical business, and Simon's right. Just need to wait for the cycle to turn. But I don't think it's turned. I think if anything, we're in the early stages of a downturn, and it's just way too early.
Yeah, we've got comments there.
Yeah. Thank you to Tibster, by the way, for that LME stocks versus copper price. I'll have a read when afterwards. Right. Well, it's now 10 o'clock, so I think it's time to start wrapping things up. Thank you very much for your hard work, Rogue. Is there anything else you'd like to discuss?
No, I haven't. If anyone's got any general questions for either of us, they could now slip them in now.
I'm just grateful for all the work you've done. I mean, it's just fabulous what you put together, the Rogue. I haven't got any questions at the minute, apart from getting to bed. But yeah, well done. Yeah,
thanks, Rogue. Great.
Thanks
really
very much.
Actually.
Yeah, I really appreciate you saying that. Thanks. I'm glad that it's appreciated. I kind of I kind of do it for myself, because I find that unless I put the work in to do a YouTube video, I just haven't got the discipline to put the work in before making investment decisions. So that's why I started doing the videos. And it's really great if other people appreciate them. And I think there's a good, a good group of people that are subscribers, and I think it's the same with Portfolio Matters. I think the kind of style of actually, less flash, less hype, but more detail, that tends to attract a good group of guys and ladies.
Yeah.
So
the videos you do, you really put the work in. Seen Yellowcake, BP, Total, and I'm working my way through them. GlaxoSmithKline. You go through everything, basically that you can do, or a private investor can do. So I fully recommend them if no one's seen them. So they're fabulous. Yeah, well done.
Yeah, thanks. Yeah, I'll give my channel a quick shill then. So anyone who's not seen my channel yet, it's Rogue Trader, the YouTube channel Rogue Trader. But actually, touching on what we've gone through today, you can see my learning process, because I started out several years ago now with stock picking, and over the last, well, from 2020, I did lots of videos of stock picking, videos of individual stocks, and then my kind of lesson from that was that actually, if you're not investing in the right sector, there's no point in investing in a stock, regardless of how good it is. And so that's why now I'm more trying to look at sectors first, and then once I've found a good sector that I definitely want to go in, then I might do a bit of stock picking. So you can kind of see that evolution as I've learned as I've gone along, really, in my video series.
Yeah.
Yeah.
No, I completely agree with that approach.
Yeah, great stuff, Rogue Trader. I appreciate all the input, and I think when you do things like that, you're right. You get people have different ideas and different takes on the same kind of stock, and I think it's always having a debate a great way to do this kind of work. Main thing is not to be confused with Nick Gleason, of course.
Yes. Yes. I mean, I did. Yeah, that was. I did worry about copyright or something, but
Yeah.
but I think the name more comes from being a kind of outsider, financial outsider, than anything else.
Yeah, I'm with you there.
Great. Okay, well, let's wrap it up there. Thanks, Rogue, once again for all your hard work. And we're going to do it again next month, I think. We've got a date in the diary.
Definitely.
And I know it's the 9th of Wednesday, the 9th of August.
Great. So I'll hopefully be posting this on my channel. And so anyone watching in the future, come back and join us on Wednesday, the 9th of August, by going onto the Portfolio Matters Discord, and then you can come and take part from there.
Yep, brilliant.
Great stuff.
Great. Well, thanks everyone for coming, viewing, and thanks to Rogue Trader once again for his hard work, and thanks to everyone who contributed. It's been great.
Yeah, thanks a lot, Keith. Brilliant.
Cheers,
Okay.
everyone. Bye.
Cheers. Bye.
Please read the disclaimer. Remember that prices can go down as well as up.